Hey guys, it's Adrian here, the Canadian in a t-shirt. And today, I'll be breaking down why I love dividend investing, especially now during a recession. Investing in dividends offers a ton of benefits, both financial and psychological, that can really help us survive and thrive during a market downturn. When the markets are down, I don't panic and sell. I use it as an opportunity to buy more quality dividend stocks at a discount, as you've seen in many of my past videos. And that's exactly what I'm doing right now in my portfolio. Let's get this out of the way. I'm not saying that you should only buy dividend stocks. One of the pillars of my investing mindset is diversification. You don't ever want to put all your eggs in one basket. So you don't have to choose one strategy or the other. You can do both. I invest in ETFs and individual stocks. I invest in dividends and growth stocks. I look for passive income and capital appreciation. There are always opportunities to be found, especially during a market crash, and dividends are one of the best things you can do with your money. This is chapter 10 of my Millennial Investing Guide, my videos with the light green thumbnails. So click the pop-up at the top right to learn the basics of stocks, ETFs, REITs, and how to invest during a market crash. In particular, make sure you watch my Dividends Explained video, where I break down how dividends work, their benefits, and what to look for when choosing dividends. As a quick recap, when you own a stock, you own a small piece of that company. Stocks can earn you money in two ways: capital gains and dividends. Capital gains are simple. If you buy the stock at a low price and years later it grows in value, you can sell that stock for a profit. That profit is called a capital gain. But some stocks can also earn you money just for holding on to them. That's called a dividend. Dividends are a percentage of a company's profits that they pay out to its investors like you. And you don't have to do anything to earn this money. You don't have to sell your stocks or work for the company. As long as you own at least one share of a company, you will receive a dividend. Dividends are the easiest source of passive income. You literally make money in your sleep. You could think of dividends as an incentive to encourage you to invest for the long term because they are paying you throughout the year. With capital gains, you only make money once, the moment you decide to sell your stock. But with dividends, you get paid many times, every 3 months or every month. That's one of my favorite things about dividend stocks. You are never wasting time. Even during a market crash, when your stocks are down across the board, your dividend stocks are still earning you money. But when growth stocks are down, they are not doing anything for you. As an example, let's look at a growth stock like Facebook, now called Meta, over the past 10 years. Right now, Facebook is at a low point. Its stock is worth about $168 per share. This stock is worth the exact same amount as it was 5 years ago, back in August 2017. So in effect, these past 5 years were wasted. During these 5 years, you didn't earn any money holding onto your shares. If you bought Facebook stock 5 years ago, you would be in the exact same position as if you bought the stock today. You weren't compensated at all during those 5 years for holding on. You just wasted time, and you're right back to where you started. In fact, you're actually worse off because of inflation. Your $168 today is worth less than it was 5 years ago. With growth stocks, the only way to make money is to sell your shares for a profit. But we want to invest in the long term, which is why you probably didn't sell during these 5 years. Eventually, Facebook will recover, and if you hold the stock for another 10 years, you will likely make a nice profit. But those 5 years were still wasted time, and that sucks. You know how hard you work for your money, so you want your money working just as hard for you. And with dividends, your money is always working 24/7. There's never any wasted time. Let's compare our example to a dividend stock like CIBC. CIBC is also down right now to a recent low of $60 per share. Again, this is the same price it was 5 years ago, back in 2017. So in terms of capital gains, it's the same as Facebook. It hasn't made any capital gains in these past 5 years. But CIBC also pays out a generous dividend every single year. So this time was not wasted. With a dividend stock, you don't have to sell your shares to earn money. Just by holding onto CIBC stock over these past 5 years, you've been earning between 4% and 6% every single year in pure passive income. And if you bought the shares at the lowest point during the 2020 crash, you would have locked in an 8% dividend yield because you took advantage of the discounted prices. I'll come back to this point later in the video. That's why I love dividends. Whether the market is going up, down, or sideways, I still earn money, and I am always being rewarded for my time. Another great thing is that dividend stocks are usually more reliable, dependable, and less risky investments than growth stocks. Remember, the only way to make money with a growth stock is to sell it for more than you bought it for. Because of this, the price of growth stocks can easily be manipulated, overinflated, and driven by emotion. People who are heavily invested in these speculative stocks can hype it up on YouTube or Reddit and convince enough people that the stock is shooting to the moon, even though the company is fundamentally not worth that much, and the company might not even make a profit. Even large, well-known companies can be overinflated like this. Remember in my video on how to analyze stocks, I went over the importance of the price to earnings ratio and saw that even giants like Shopify and Tesla can be massively overvalued. And when reality kicks in, the hype bubble bursts and we can see these stocks plummet 50, 60, 70%. With dividends, this is far less common because dividend stocks tend to be less volatile and valued fairly. And here's why. A dividend isn't money that appears out of thin air. A dividend is a percentage of a company's profits, meaning that a company needs to make a profit to pay a dividend in the first place. A company only starts paying dividends once they have a long history of consistent and reliable income. That's why dividend stocks tend to be well-established industry leaders. We call these blue chip stocks. Companies that have been around for decades, they always earn a profit and they grow at a steady rate year after year. They're not going to double in value overnight, but they aren't likely to plummet either. Those are the companies you want to own. And since they have such a long track record, the market knows how much they are worth and how much their dividend yield should be. So every year they earn more income, more profit, the company is worth more, so the share price grows. As the share price grows, they also increase the dividend to keep the yield relatively steady. This is a simplified explanation, but essentially, all of these metrics are working in balance to keep the dividend stock from swinging wildly up and down in value. But let's say that a viral YouTuber was able to hype up a dividend stock like CIBC and cause the share price to double overnight. This would throw off the balance. Investors expect CIBC to pay a dividend yield around 4%, but now the share price has doubled, so the dividend yield is reduced by half to only 2%. For CIBC to maintain their expected 4% yield, they would have to double their dividend overnight, but they can't do that. A dividend comes from the company's profits. They can't pay out more money to dividends than they bring in. That's not sustainable. And so they'd have to cool off the share price and return everything to normal, reasonable values. This is a very simplified, artificial example, but the point is that with established dividend stocks, there are a lot more checks and balances to keep the share price reasonable and valued fairly. Generally speaking, dividend stocks won't be as volatile. It'll be a much smoother and gradual upward climb. They won't 10x in value, but they won't crash and burn either. That's what you want from long-term investing. Boring and dependable. No stress, just peace of mind. That leads us to our next benefit, the psychological boost of receiving dividends in your hand. When your stock grows in value, you haven't made any money yet. Your capital gains are unrealized. You're making money on paper, but you don't actually have any money until you decide to sell. But when you receive a dividend, that money is real and it's yours. That cash is in your pocket and no one can take it away from you, even if the market crashes tomorrow. Don't underestimate the psychological benefit of receiving passive income every month or every quarter. As humans, we're still animals, and it's difficult to delay gratification, especially when it comes to money. Everyone needs money, and we need it now. You can listen to a YouTuber a million times say that true wealth is built in the long term, and that's true, no question. But it's hard to put that money aside and hold on to hope that we'll be rewarded years down the line. We need to see results along the way. Dividends give us a mental boost that encourages us to keep going. When you receive a dividend, that money is proof in your hand that you're on the right path to building your financial future. I've been investing for almost 10 years, and still, when I log onto Questrade and go to my account activity and see those dividends coming in almost at a weekly basis now, it gives me a thrill and a sense of pride. It makes investing fun rather than a chore. That's why I'm always smiling in these videos. In fact, my favorite day of the month is the 15th. Why? Because that's when I receive most of my monthly dividends from REITs, my real estate stocks. And to make it even better, I reinvest those dividends to buy more shares using a DRIP. That's where the real fun begins. Now, every single month, I gain new shares totally on autopilot. So every month, I receive more and more money. It's compounding. I'm not just receiving the same $100 payment every month. That would be linear growth. But with a drip, the first month I'll earn $100. Next month I have more shares, so I own $103. Then $107, then $115. My rate of income is accelerating, and that is the power of exponential growth. And that is how true wealth is built in the long run. Check out my Drips Explained video where I illustrate the power of compounding dividends and I show you how to set up a drip with Questrade, my favorite online broker. And if you'd like to get started with Questrade, click my referral link in the box below and you'll get $50 in commission-free trade rebates for the first 30 days when you sign up. That basically means that your first 10 stock trades will be commission-free. That saves you $50, plus I'll get a small referral bonus as well. Receiving that steady passive income from dividends also makes it much easier to track your progress and manage your retirement goals. For me, retirement is not an age. I don't want to retire at 65. For me, retirement is when my passive income is enough to cover all of my living expenses. At that point, I can choose to stop working. I can literally sit on a beach all day, making money in my sleep, and my dividends and rental income are enough to cover my lifestyle. If I want extra money, sure, I can choose to keep working part-time, but that's my choice. And to me, that is freedom. Tracking my dividend income and seeing that number grow year after year is so rewarding, and it gives me a rush of motivation to keep going. I've said it many times, when markets are down, I use it as an opportunity to buy more quality stocks at a discounted price. A big reason why is that I know that the companies are still solid. The drop in the share price is just driven by fear and panic. So when the share price recovers, I will have made easy capital gains because I bought in at a low point. But with dividend stocks, I get an extra benefit that's even more powerful. I get to lock in that higher dividend yield. And I get this benefit every year for life, not just a one-time capital gain. Let's go back to my CIBC example. Normally, CIBC pays out a dividend yield around 4%. That's great and reliable passive income. As the share price grows over time, we expect the dividend to grow as well to maintain that 4% yield. And so we have reliable capital appreciation and growing dividends. That's wonderful, and that's enough to build long-term wealth. But when the markets are down, we can add fuel to the fire and kickstart this growth. The share price has dropped by 25%. So with the same amount of money, we can afford to buy 25% more shares. And each of these extra shares that we bought on discount pay out the same dividend as the normal shares we bought years ago. So if we buy $1,000 worth of CIBC stock right now on sale, we're not just getting the normal 4% dividend yield, we're getting a higher dividend yield of 5.5% because we're buying extra shares. And even better, we're locking in this higher dividend yield for the rest of our lives because we'll always own those extra shares, which pay us extra dividends. The dividend yield represents the annual income you'll receive on the money you're investing today. So when the share price drops, use that as an opportunity to buy more shares on sale and lock in that higher dividend yield. Of course, this is only as long as the company is still secure and the dividends are sustainable, as I've talked about in my past videos. But with a company like CIBC, which has growing revenues and a low payout ratio, those dividends are definitely sustainable, and they'll continue to increase those dividends year after year. If you'd like to see exactly which stocks I'm invested in, companies like CIBC, and to help support my channel, hit that join button down below to gain access to my exclusive videos like my TFSA and RRSP portfolio reveal, and to see exactly what stocks I'm buying every few weeks. But remember, don't just blindly follow a random guy on YouTube. Everyone has their own financial goals and circumstances. I don't want you to copy what I do, but I hope that seeing my portfolio might offer some guidance, especially if you're just getting started. So there you have it. Those are some of the reasons why I love investing in dividends, especially during a market downturn. With dividends, your money is always working for you. You can count on reliable passive income, giving you peace of mind and long-term growth. And when the market is down, you get to benefit from both capital appreciation and locking in a higher dividend yield. Thanks for watching, guys. Be sure to like, comment, and subscribe if you found this video helpful. Every thumbs up and comment really does help me build this channel here on YouTube, and hit that bell icon to be notified of my new videos. And if you'd like to follow me on Instagram or Facebook at Canadian T-shirt, click my link in the box below or click the links on my homepage. Thanks everyone, and I'll see you guys on the next episode of the Canadian in a T-shirt. Bye guys.